Basic types of capital rationing. We have the hard capital rationing. We have the hard capital rationing and soft capital rationing. What is hard appraisal called capital rationing? Now, every company might have several projects to undertake, and all the projects might be positive. But there is going to be, or the company might have limitation of resources. Company might have limitation of funds. So if the company has limitation of funds, then the company will not be able to undertake all the projects. If the company is not able to undertake all projects, it simply means that shareholders' wealth will not be totally maximized. So if the company is to undertake the projects, because all of them have NPVs that are positive, it must allocate its limited resources to the projects that it thinks gives shareholders a lot of return. But how can the company undertake those computations, and how will it be able to decide which project to allocate the scarce resources to? So the shareholders or the managers will have to ration or allocate the resources to the projects that they find worthwhile. But there are two basic types of capital rationing. We have the hard capital rationing. We have the hard capital rationing and soft capital rationing. What is hard capital rationing? Now, hard capital rationing is restrictions imposed. It's restrictions imposed by lending institutions. On organizations. So lending institution can come out as a result of many factors on why they cannot lend to a particular company. Now, the soft capital rationing is when the company imposes restrictions on its own self. But what are some of the factors that might cause hard capital rationing? Number one, the first one is industry-wide factors. So let me use a different so the first one is industry-wide factors. Examples such as limited funds by the lending institutions. When they don't have enough funds, they cannot lend to a company. Two, company specific factors. Company specific factors. And these factors include such as lack of proper track record. So when a company does not have a track record of paying for its funds that it borrowed, then it cannot raise funds from the external market. 2, lack of asset security. So when the company does not have any collateral security, it cannot access funds. Poor management team. So when the management that are not competent enough, they will not be given a lot of money, because lenders will be questioning how well management can allocate those resources and pay back that capital with interest. Now let's go to factors for soft capital rationing. So that one, we have limited management skills. So let's take it for instance that a company wants to undertake a new project, of which it has assessed the skills that is needed for the effective management of such project. If management finds that it doesn't have enough skills for the management of that project, it may restrict the amount of money it invests in those kind of projects. The next one is desire to increase return of limited number of projects. So a company may decide that, okay, we have several projects, but let's concentrate on these few projects in order to maximize the returns from such projects. So you are not going to pull out or dole out a lot of funds to invest in other projects, because their concentration is on those few ones that they want to maximize returns. The next one is limited exposure to external finance. Limited exposure to external finance. Though the company might not be listed on even a stock exchange to be able to access a pool or a large pool of funds. So if they have limitation on how much they can raise, that will be what soft capital rationing. So these are few examples of factors that may cause hard and soft capital rationing. There is also what is described as single period capital rationing and multi-period capital rationing. Single period capital rationing simply means limitation of funds for only a period, and this one is for more than one period. Hope you understand. Now let's go on and look at how companies can allocate its resources to projects when it has limited resources. Now, for a company to allocate its resources to projects, it must identify whether the projects are, it must identify types of projects. So let's look at the types of projects. Now, a project can be divisible, non-divisible, the project can also be mutually exclusive. Now, what is the meaning of divisible project, non-divisible project, and mutually exclusive project? A divisible project is a project that can can be undertaken in pieces, or is a project that a part of can be undertaken. So when we say a divisible project, it simply means that a part of the project can be undertaken, or let's say a part or percentage of the project can be undertaken, okay, with returns gained according to that percentage. So let's take, for instance, there is a project, say project A, and if the project A is divisible, it means that we can undertake, say, 40% of the project, with the rest 60% not undertaken, or not we can undertake 40% of the project, with the rest of the 60% not undertaken, and we are going to earn gains according to the 40% that we undertook. Okay, now non-divisible projects means that a part of the project cannot be undertaken. That is, it is either undertaken in whole or not. So the first one is that if we have a process, for example, if we have a project A and it's not divisible, it's either we undertake the whole project or we leave it. So that is indivisible project. The next one is mutually exclusive project. When we say a project is mutually exclusive, we mean that the selection of one project precludes the selection of another. So here, if you have two projects, say project X and Y, and management select X, it means that Y cannot be selected. So it means X and Y are mutually exclusive. If management, on the other hand, okay, so let me clean it. So here, X and Y. If management select X, it means Y cannot be selected. So X and Y are mutually exclusive. If, on the other hand, management selects Y, X cannot be selected. Okay, so now let's move on and I take a very important thing in the identification of which projects to allocate our scarce resources to. Let's take, for instance, a company has three projects: project A, project B, project C. Project A has an NPV of 11,000, project B has an NPV of 17,000, and project C has an objective NPV of 9,000. Now the question is, which of these projects should the company undertake or implement? Because all of them have positive NPVs. So if all of them have positive NPVs, then it means they are all worthwhile to be undertaken. But the company might have limited resources. So it needs to ration the limited resources on all the 3 projects, to the extent that maybe some of them might not have to be undertaken. So for the company to decide which of the projects to undertake, it must have a more superior computational tool to decide between A, B, and C. And that computational tool is what is described as profitability index. So let's go on and do what is called profitability index. So that is described as profitability index. So profitability index. Now, what is a profitability index? Profitability index simply means the net present value of a project divided by the initial investment. So let's take for instance that for each of these projects, the initial investment for A is 100,000. The initial investment for B is say 90,000. The initial investment for C is 150,000. What is the profitability index? So for A, the PI is equal to 11,000 divided by 100,000, and that one is going to give us, that will give us 11,000 divided by 100,000, and that will give us 0.11. For B, profitability index is equal to 17,000 divided by 90,000, and this one is going to give us, this one is going to give us 0.188%. So for C is equal to 9,000 divided by 150,000. Okay, so let me write 150,000. So 9,000 divided by 150,000, which is 0.06. Now, what can you do? You select the project based on the profitability index and which one is the biggest. So when you look at this one is the first because the 0.18 is higher than 0.11 and 0.06. So this one is the second and this one is the third. So you allocate your resource based on the highest profitability index. So let's move on and see what we mean by divisibility, non-divisibility, and mutually exclusive. Okay, so let's take for instance that this project, for the 3 projects, the company only has say 120,000 as the funds. The company has funds of only 120,000 to allocate to the 3 projects. If the projects are divisible, then which of the projects should they invest their funds in? Okay, so divisibility. Now, the projects, the NPVs or the benefits that we've computed and the funds to be allocated, Okay, so the first project to be undertaken should be project B because it has the highest PI. So project B should be undertaken first. And we are going to have an NPV of a benefit of 17,000 with initial investment required being 90,000. Now if the projects are divisible, it means that we can undertake a part of another project. Okay, part of another project. So here, having allocated 90,000, we are only left with 30,000 of the funds left. We are only left with 30,000 of the funds. Sorry, we are only left with 30,000 of the funds. So the next one, which is the next the next best project, is project A because that is the second. So we go to project A, and that is going to give us an NPV of 11,000. Okay, sorry, and that gives us a project of 11,000. But that requires an initial investment of 10,000. But the funds available is 30,000. So we are only going to invest the 30,000. It means that we will not have 70,000 for project A. Therefore, we are going to earn only a proportion of the 30,000 that we invested. So 30,000 over, so we have 30,000 over the 100,000 that we require to invest times 100%, and this one will give us 30%. So we are only going to earn 30% of the 11,000. So 30%, so here we are going to get 30% of 11,000 will give us 3,300. So 30% times 11,000 will give us 3,300. So the total PV or benefit we are going to get will be 20,300. That is when projects are divisible. But what if the projects are not divisible? What if the projects are not divisible? So let me clean this one. What if the projects are not divisible? So here, non-divisible. The projects are non-divisible if the projects are non-divisible, it means that a proportion of the project cannot be undertaken. So we go through the same process. The first one to be undertaken is what? Project B. So project B with NPV of 17,000. Okay, and the funds to be allocated will be 90,000. Now, since the projects are not divisible, there is 30,000 left, but we cannot undertake any other project because we cannot the projects are indivisible. Therefore, a proportion of any project cannot be undertaken. Therefore, the only project we are going to undertake is project B, and the total NPV was 17,000 with initial funds of 90,000. That is all. Now let's go to mutually exclusive. So mutually exclusive. Let's take it for instance that project A and project B are mutually exclusive. They are mutually exclusive. So it means that the selection of A precludes the selection of B, and the selection of B precludes the selection of A. Okay, so now the best thing that we have to undertake is next thing we have to undertake is the project, the NPV, and the allocated funds. Now, the best of the two is B. So we are going to undertake B. So since we have selected B, A is automatically out. Okay, so we are going to have 17,000 and 90,000. Then the next thing that we have to consider is C, because A is automatically out. And for C, we require 150,000. Okay, we require 150. So if the projects are mutually exclusive, then it means that we can only go and we can only undertake the 30,000 of the 150,000. Now 30,000 of the 150,000, 30,000 over 150,000 times 100 will give us 15. This will give us 20%. So it means that we can only earn 20% of the NPV, which is 9,000. So 0.2 times 9,000 and 2 times 9,000 is 1,800. So the total NPV. Hello. Now, having looked at the explanation of divisible and non-divisibility of projects, mutually exclusive, and capital rationing, let's look at this particular question to gain further understanding of what we learned earlier. This question is about a company called Fictrex Company, a medium-sized or equity-financed unquoted company which specializes in the development and production of water and air filtering devices to reduce the emissions of effluents. Its small but ingenious R&D team has recently made a technological breakthrough which has revealed a number of attractive investment opportunities. It has applied for patents to protect its rights in all these areas. However, it lacks the financial resources to exploit all of these projects, whose required outlays and post-tax NPVs are listed in the table below. Fictrex managers consider that delaying any of these projects will seriously affect their profitability as competitors bring forward their own new developments. All projects are thought to have a similar degree of risk. So all the projects, as can be seen here, the initial outlay is here, the NPVs are associated with that. The NPVs have been calculated using a discount rate, the 18% post-tax rate of return which Fictrex requires to risky R&D ventures. The maximum amount available for this type of investment is 400,000. Is 400,000. 400,000, corresponding to Fictrex's present cash balances. So that is the only amount they have for all the projects, for all the 5 projects, built up over several years, profitable trading. Project A and Project C are mutually exclusive. Very important point to note. Project A and Project C are mutually exclusive, and no project can be subdivided, so all projects are non-divisible. Any unused capital will either remain invested in short-term deposits or used to purchase marketable securities. So if we undertake any of all the projects, whatever is left, you can invest in marketable securities or short-term, both of which offer a return well below 18%. The question is, advise Fictrex Co using suitable supporting calculations which combination of projects should be undertaken in the best interest of shareholders. Now, in order to achieve best interest of shareholders, we need to go ahead and calculate what is called the profitability index. The profitability index. Now, what is the profitability? It's a superior method that is used when all projects have positive NPVs. Therefore, management are indecisive, or management cannot identify the precise projects to invest in because all the projects have positive NPVs. We learned earlier that if a NPV project has a positive NPV, it should be accepted. But when we looked at capital ration, we realized that companies might have insufficient resources or scarce resources, of which inhibits or restricts their ability to invest in all projects. Therefore, they have to go ahead with a superior method in identifying particular projects they should invest in. So, using the the profitability index, we can identify which of the projects the company should invest in. The profitability index is calculated as the NPV of a project divided by the initial or the initial capital cost. Initial capital cost. Okay. So having noticed this, then let's go ahead and calculate the profitability index of all the projects. So project A, the PI for project A, okay. So for project A, the PI is equal to 65,000 divided by 150,000, giving us 0.43. Then project 65,000 divided by 150, 0.43. Then project B, the profitability index is 50,000 divided by 120,000, giving us 0.42, nearest to the nearest two decimal places. Project C, the profitability index is 80,000 divided by 200,000, and that will give us 0.40. Project D, let me clean it here. So project D, the profitability index is equal to 30,000 divided by 80,000. 30,000 divided by 80,000, giving us 0.38 to the two decimal places. Then project E, the PI equals 120,000 divided by 400,000, giving us 0.3. Okay, now looking at the PI for all these projects, we realize that project A is the most profitable compared to project E because it has the highest PI and this one has the lowest PI. Now the question is asking which combination of projects should be undertaken in the best interest of shareholders. So we are going to look at the combinations. So the first combination now we need to take into account the mutual exclusivity and the non-divisibility of projects. You realize that project A and C are mutually exclusive, and all the projects are non-divisible. So the selection of A precludes the selection of C, and the selection of C precludes the selection of A. Okay, so the first combination, the best of all the projects is project A. So let's look at project, the NPV, and the costs, or let's look at the outlays. So outlay. So the best project to select is project A. It offers a return of 65,000 with initial cost of 150,000. Now we move on to the second best, which is project B, offering 50,000 with initial outlay of 120,000. Now we should move to C, but C and A are mutually exclusive, therefore C cannot be undertaken. Therefore we should move on to project D. So project D with returns expected of 30,000, okay, with initial outlay of 80,000. Now when we add 150 plus 150 plus 120, we get 270 plus 80,000, which is 350,000. Now 350,000 is way below the 400,000 which is available. Therefore we still have 50,000 to invest, because 350,000 plus 50,000 give us 400,000. So we still have 50,000 to invest. So we should move on to the next one, which is project D. However, project D requires 400,000. So therefore we cannot undertake that project because projects are non-divisible. Therefore we have to, so the total of this will give us 350,000 with the NPVs giving us 145,000. But we are going to have excess funds of 50,000 to arrive at 400,000. Okay, and the NPV is going to give us 145,000. Now these excess funds will be invested. These excess funds will be invested in marketable securities and short-term deposits. Okay, so that is the first combination. Let's look at the second combination. So the same project, the NPVs and the outlay. Now we are not going to start all over. We are now going to go through the schedule again. So the best one to start is what? A. But when you look at the first combination, we have already selected A. Therefore we cannot select A again, okay, because we have combined different projects in a different sequence. Therefore we cannot select A again. So we start with B, which is the best one, which gives us 50,000 with outlay of 120,000. Now another reason why we cannot select A is that A and C are mutually exclusive. So if we have considered A in the first combination, we cannot consider it again in the second combination. Okay, the next one to choose is C, because A and C are mutually exclusive. So we want to see the combination that C will have. So C offers 80,000 with initial outlay of 200,000 So let me correct it, this one here, 200,000. Then 200,000 plus 120 will give us 320. Therefore, we still have 80,000 to spend on the project. So we move on to the next one, which is project D. The project D requires initial investment of 80,000, which is equal to how much is left for us to invest, with NPV or returns expected of 30,000. Therefore, we have exhausted all the amount that we have available, and this is the next combination. So this one will give us $400,000, and this one will give us $160,000. So the second combination is B, C, and D. Okay, now let's look at another combination, which is the third combination. Okay, so the third combination is, now we have looked at all the projects, but one project that we have not looked at is the project E, which requires initial outlay of 400,000, giving us a return of 120,000. Therefore, we want to look at that combination. So project, the NPV and the outlay. So project E will give us NPV of 120,000 and requires an initial investment of 400,000. So it means that if we spend all the 400,000 on project E, it will give us 120,000. Now they're asking, which of these combinations should be undertaken in the best interest? And what is the best interest of shareholders to maximize their wealth? To maximize shareholders' wealth. Now, shareholders' wealth is maximized when companies invest in the most profitable projects that gives the highest returns. So we are only going to compare the returns that we are going to have for the three combinations and choose the combination that gives the highest returns. Now for the first combination we have 145,000, the second 160,000, and the third is 120. So we see that the best combination is the second combination because it offers higher returns. Therefore, the projects that will offer the best interest of shareholders is project B, C, and D. Hope you understand.